Okay, g'day, my name's Rudy. I started this channel March last year to help people build investment portfolios in their, whether it's their member direct in super or self-managed super fund, or just putting an ETF portfolio together using technical analysis as the main decision maker, but obviously fundamentals. So in this video, I just want to show an example of how chart patterns can be used to make buy and sell decisions. And Ansell is currently one in our model portfolios, our dividend portfolio. All right, so Ansell, so the rounded bottom, sometimes known as, with this one, the reverse head and shoulders, shoulder, head, shoulder. So you buy the breakout of the neckline, then you project the target, which is the depth. So you take the depth of that, add it to the projection. So that gives you a target price. It obviously doesn't talk, it just gives you an indication. But in this case here, we've got a shooting star candle, where basically the price starts here, goes whoop, whoop, gets sold down. So a bit like there. It's a very good indicator of a top, just like this is a pin bar, a bullish one the opposite way. A good indicator of a bottom. Okay, so you're out of Ansell. You couldn't have invested in that period there. It's too choppy. If you were, you would have had a chance to get out. You got a rounded top, which is the opposite of the rounded bottom. So break of neckline is a sell. Then you would have had another break of this trend line here would be another sell. Okay, so now we're forming another one of my favorite patterns, which is the declining wedge. So declining wedge, once broken, is bullish. So at the time, we would have bought that, and we are big users of stop losses, which is like if you get it wrong, price drops below there, you're out. And just to show you, so I do, if you join my Substack, so I do daily alerts. So this is a new addition to the tank, 27th of May. So you can see we put Ansell out as a buy. So you buy there with a stop loss here. Because it's important to use stop losses because you don't always get it right. And you also don't want to fall in love with a stock. That's rule number one. So if it doesn't work out, you're out. You lose 2-3%, move on. Okay, so we've got the declining wedge and the rounded bottom break. So we're currently in this. So at this stage, we projected a target to here. So it's obviously past our target now. So it doesn't mean you sell. You got to wait for one of these type of candles to indicate a top. But we are, so we will be selling this at some stage. It was paying 3% div on purchase, but if it's going to consolidate, come back 5-10%, rather find another dividend stock. That's it. We're trying to keep this model portfolio to a minimum of 4% div. Anyway, so what are we looking at now? So we've got the 200-day moving average. So that's one. That's one indicator. The declining wedge, you take the widest part of the wedge and add it to the breakout zone. So that gives us another target. And if we use the Fibonacci retracement, so from this low to this high, so 50 to 60, so again this 50% a common place for a correction. And we've got congestion up here, so I'm figuring we'll be looking for a shooting star somewhere in this area to sell it, because then that would have, we would have locked in a nice 20% gain in about a month. That's about what your super fund does in 2 years. All right, so yeah, as I said, we've got model portfolios. We got, if we look in the right place, so we've actually got a ninja one, which so Ansell wouldn't be in a ninja. It's ASX 300, but they're more the smaller cap side of things. But they are in the ASX 300, which is we're up just over 160% for the. We started in July last year, so we've got the ninja and the dividend tank. All right, so if you're interested, join the Substack. It's all in the. Check out the description in the YouTube vid. It tells you all about what we do. Otherwise, have a good one.